Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Good morning, everybody, and welcome to the final FX webinar of the year. Very much looking forward to hearing what Piers has to say, and as has already been mentioned, I'm going to be delivering a look at the summary views from our year ahead document, which hopefully you'll already have received or have seen. But without further ado, I'm going to hand over to Piers. Piers, you're going to be the festive cheer. I'm going to be the Christmas Grinch. I look forward to hearing what you have to say.
Hi there, Neil. I have a Christmas cheer in the form of a bad cough at the moment, so apologies about that. I think there might be some cheer, but I think it might just be sort of coming to an end. December's a very difficult month as ever because liquidity thins out. The markets do some strange moves, and there might be some profit taking into the end of the year, which might exaggerate things. But if we go to the first slide, we'll kick off with what we think. So the next slide is going to be here. This slide here is what I said last month on the dollar index. So I'm going to start with the dollar index as normal. This lets us see what's happening with the world's main traded currency. And so it's really important. Now, last month, I highlighted the inside session, and so that's normally a reversal month, And if we go to the next slide, you'll see it was a very good warning. It came off that 76.4. You had the biggest drop in dollar value since, I believe, looking on my charts, it's since the financial crisis time. So it's a massive drop last month. And we saw price go down to the 38.2% of this rally up and paused there last month. And this month it's trying to test down. Now, what makes it more difficult is that this is December. You often get some strange moves in December. But the key thing is you've had that very negative month come in. So I think that it's a very big signal that we just can't ignore. And if we look at the next slide here, we can look at it was at the top of the Bollinger Bands and it's come off there. So these are Bollinger Bands. So we know the 104, 105 area is support, and that sort of seems to be holding. But where is below that? Now, below that, we had 61.8% on the retracement, and also the actual moving average of the Bollinger Bands comes in about 99 as well. So if we do get a move down low and this move lower continues, then it could go down as far as 99 before getting some bounce. But I would expect at some stage a bit of a bounce. It's been a massive move down. I think the dollar had a lot of strength. It strengthened very quickly. But there'll be a stage where it comes back down, where people will start to think, will I buy back into this? So watch what happens at the 104, 105 area and then down at the 98, 99 area. That's the main areas to watch. Because it was such a negative month last month, if you get my weekly charts, one of the areas I've been mentioning is 108, 109. So while you're below 108, 109, that negative field sort of continues. To get back to neutral sort of mode, you just need to get back above 106. So it's going to be very important to watch those levels as we proceed from here. What won't help, what won't help is having December and the thin markets and people doing end of year positioning. So we might have to wait till next year until we get a clearer picture. Now, I think this year's been quite a straightforward year when I look at this, because we had the break above in earlier on in the year, April, we were saying, look for massive dollar strength. We got that. Then you're having this pullback. Now, is this pullback a start of a bigger move back lower? We saw it in dollar yen turn at a key stage, or is it just a pullback before it goes back higher? So next year is going to be a much more difficult year. And so I really suggest you start watching next year's webinars, because that's where the truth is going to come out. This month might be all muddled, as I say, year-end liquidity. But if we go to the next slide, we're going to look at euro dollar. So euro dollar here on the monthly chart, I like this 107.68 area. So it's the lows, if you look back 2020. It sort of capped the rally back up in 2022 once it got broken. So I think that's going to be a key area as price goes back up. And that's an area I'm going to watch on the monthly charts, because if price goes back up there and starts to fall off, I'd expect some fall off there, then maybe we're going to see a bit of a move back down in euro dollar. But this is very much what we were looking for in the last webinar. In the last webinar, we're saying, the 97 area had been hit. Look for a retrace towards 103 and potentially 106, 107.75. And if we look at the next slide, you can see that price has stalled just below that 106, 107.75 area. It's where price is just stalling at the moment. So price has done the move we're looking for. It's been a very strong move, because remember that move up in euro dollar, that's the largest rally, 1 month rally. I think probably the same thing. It's probably the same biggest 1 month rally probably since, you'll find, financial crisis, but I'll have to check on that. But it's a massive move up in 1 month. And again, we're going to have that month-end confusion. But for the moment, watch the 106, 107.75 area. The important area to watch is 102 as it comes back down. If price comes back down and falls back down to the 102 and then has a push back up, then this trend is intact. This attack back high is intact. But that's something I think we'll have to look at into next year. Excuse me. So if we go to the next slide. Sterling index, my favorite chart. So what can I say here? What can I say hasn't been sort of said? It feels like since the dawn of time that, well, maybe not the dawn of time, since Brexit maybe, but it goes up to that 38.2% and fails. Earlier this year, we warned it fell off there, bearish outside quarter, price fell down. Then we got that exaggerated move a couple of months ago where price absolutely collapsed down lower. Everything went wrong for sterling. But the one thing we did say was the spike on the downside. Look at the spike on the last quarter, very big spike. And that's pushing the price back up. But we can't get really positive on sterling until it gets through that 38.2%. At the moment, it's just retested the trend line. So it's been a break of the trend line. You've retested up the trend line. And I say more neutral on sterling at the moment, unless it breaks through that 38.2% at the 64.90 area. Now, if we go to the next slide, you'll see the Morning Star. Now, the Morning Star, I highlighted the other month on here, and it was saying about the spike on the bottom. So in all that confusion around when we had that mini budget and a quick change of leadership in the UK, prices collapsed and then rushed back up. So it leaves a spike. And normally it's a spike, people take advantage of that, and the spike is a turning sign. And here it's been exactly the same. It formed this Morning Star and price has rallied since then. And we did highlight that the other month. But again, it's got to get through the 64s. So even on the monthly chart, yes, it's looking good. Yes, it could go a little bit higher, but really to get positive, it might have done the majority of the move. You need to see it through that 64. So if suddenly sterling index gets to 65, picture's changed. So at the moment, it's sort of neutral, mildly positive, but we just need to check, does it turn back negative or does it get that positive trigger? And I think for that, you're going to have to wait till next year. I don't think in December it's going to be a good true break. You want confirmed volume and active trading, whereas every week now, as we head towards December, less and less will be done. So we go to the next slide. We can see the sterling dollar monthly chart. Nothing different here than euro dollar, really. What did we have? We had the inside session. So the inside session was there. That was a warning to us, a rally back up. And at the beginning of November on the last webinar here, I said I was looking for a move up to the 122 area, the 38.2%. So we've seen that. And I said to watch the 122, 123.60 as resistance. So I think that has worked quite well. We've got up there, we've fallen off 123.60. 123.46 was the highest I saw on my system. So prices coming off where we were expecting last month. So I know that it was a bit of a shock, this, because I think on the fundamental side, they were looking sort of for 109, and we've done this move up. Now, it sort of worries me when I think that we have this move. Are we going to come back down now? So that's the key. How far are you going to fall off this resistance? So I say that if you start to get below 116, 118, you start to worry. Why has this strength gone of this move? So it's going to be very important now to watch the 123.60. I'd put just a little bit of leeway on that, maybe up to 124.25. 123.60, 124.25. That's the sort of resistance. Liquidity is going to get thinner and thinner, as I keep saying. The reason I keep saying it, because as the market gets thinner and deals have to get done and people have year-end positioning, these levels might break a bit. You might see some whipsawing action. But again, like I said on euro dollar, like I said on the dollar index, I really think next year is going to be a much more difficult year to predict. This year, we predicted earlier on in the year that you could go down to 113, 114. I think we said that in the June webinar or April webinar. One of those, we were sort of saying there was a risk of 113, 114. Then last month, we were saying, that's it, game over, look for this move up here. It's been quite route mappy. But now I think it's going to get a lot harder, especially into the new year. Is this move going, or is there going to be a major reversal here? So we'll keep you posted next year. Now, if we go to the next slide. Now, the next few slides are all very, just this. I thought we were going to Euro sterling. Just on this, I'm just going to say, this is where on sterling euro, sterling dollar, things change for me. You've got the Bollinger Bands going round the 20 period moving average. Now, we can see that the 20 period moving average, when price has been below that, it's acted as resistance, and above it, it's acted as support. So that's going to be very interesting if next year we see a continuation. Well, if it gets up to that 128, 129 area, that should be a key area to watch. So it's not something to act on now, it's just something to think about. This might help us with our longer term look into next year. But now if we go to the next slide, we're going to look at Euro sterling. This is where I thought we were going. So for the last couple of webinars, I've said that I see this in a sort of 85 to 88, 95 trading range. And if you look at this quarter, it seems still just to be in that trading range. It's been up to the top and it's coming down towards the bottom. So nothing's changed. This is just sideways. Remember, we had that big spike on the top side. So the market's selling off that spike. So it's going to sort of put the pressure on the downside, 85. And that's really down to see if 85 can provide any support for a rally back up. But on the next slide, we can look a bit closer at the monthly chart. This is a monthly webinar. So on the monthly chart, I've had a few levels to watch, and I think they've worked quite well. On this one here, if you look through, all the spikes have been contained really by 92.10. Even the spike going back just a couple of months ago, that was held by the 92.10 area. And so while that holds, there is a bit of a risk that all we're going to do is see price go down lower. 87.95, that's held as the midpoint. And we've got the 83.60 area at the bottom. So this is what I'd watch on a monthly slide, just to watch, do we get quicker clues than waiting for that quarterly slide? But at the moment, to get positive again, Euro sterling, you really need to above 87.95 on a monthly close. And if you look at sterling euro on the next slide, I've just put it onto sterling euro way. So sterling euro, I was looking there for sort of 116.85, 117.25 on the sort of, excuse me, 1 second. So on this one, I'm looking on the quarterly chart, I'm saying 117.65 down to 112.40 is the sort of range we see on the quarterly chart. And it's stayed in that range so often. as we'll see, there's the spike on the bottom. It's pushing price back up and probably going to put a bit of pressure on that 117.65 area. So on the next slide now, this is for the slide I was going to start talking about. We can see here the key levels to watch. 113.70. Look how price didn't manage to close below that. Not even with that panic the other month did it manage to close below there. Big spike, it held. So 113.70, while you're above that, slight risk towards 119, 121 area, but you need to get above there to be convinced it's going higher. Below 113.70 probably puts the risk back down to that sort of 108 area. But that's it. I've got to go to the next slide very quickly. We go to the next slide. This is just my disclaimer saying that these are all just my thoughts. I'm not giving you any advice or anything. It's just how I see the market. Because I think next year will be a lot different to this year. I think the FX markets next year are going to be very, very changeable. But I'll hand you over to Neil.
Thank you, Piers. As usual, very interesting, very insightful. So I look forward to seeing you again in the new year. I'm sure our clients do, with a technical update of how the year has closed and what that may mean for the year ahead. So I'm going to move on to the economic outlook now. As was mentioned in the invite, there's a heavy focus on what we've included in our year ahead document. Bear with us with regard to the forecast views. I think there's a lot of interesting information within the year ahead document and also the year ahead summary documents that you can find on our Market Insights page. So if you move on to my summary slide, what we're going to look at first is what the growth outlook looks like for 2023 and beyond. We'll then move on to regional breakdowns, what that means for interest rates. Are the rate rises starting to slow? Have we seen a peak in inflation? There's been quite a few surprises in the inflation stats recently. Before moving on to the FX market forecasts and my disclaimer at the end. As I mentioned, I'm probably going to be more the Christmas Grinch rather than the sort of jolly Christmas spirit. But I will try and put some positive spin on the numbers. So let's take a look at what the growth outlook looks like in the next slide. You can see here from the table, global GDP expected to be reasonably anemic over 2023. So if you look at the far right-hand side of this table, shows 2023 growth slowing from 3.7% in 2022 to 1.2%, speeding up in 2024, but that's still beneath where we would expect the global GDP number to print. A lot of that is down to slower US growth. In fact, a full-blown recession in the US expected in 2023, a stagnation in euro area growth, and the worst performing of all of the major economies being the UK over 2023, with a contraction of around 1.2%. I think that the recession is already underway. We've had Q3 numbers confirming quite a sharp slowdown in economic activity and in fact, a reduction in economic output. Q4 is likely to repeat that, and then we will get a further period of negative economic activity in the early stages throughout the sort of course of 2023, but an acceleration in that poor performance of UK economic output in the second half of 2023, when the bulk of the interest rate increases that have already been sanctioned and further rate rises to come will start to take greater effect. That then peters out into the early part of 2024 before a modest recovery ensues into the second half of 2024. But you've got quite a prolonged period of negative economic activity for the UK that isn't replicated in the other major economies. I think that the growth outlook could be worse for the likes of the US and the Eurozone, based on the potential for higher interest rates if inflation is a bit stickier. If we look at the regional breakdown, first taking a look at the US, where is the weakness coming from as far as US economic activity in the early stages of 2023, well, no real surprises here that it's coming from household consumption, from fixed investment spending, and particularly within that resi investment. The US housing market has been signaling quite a sharp slowdown in activity and a drop-off in levels of spending on housing. So if you look at particularly pending home sales, I think they're down by around about a third in the latest data. We're also expecting to see unemployment rates climbing. So if unemployment rates do climb, then I think that will lead to a further cessation of spending at a household level. And consequently, that could lead to a more prolonged period of negative economic activity. The risk here is that the period of economic activity is longer, albeit that it wouldn't necessarily be a sharper economic recession in the US. And of course, it will be dependent upon what we see from the Federal Reserve. And you can see that in 2024, we're actually looking for a sizable reduction in the Fed funds target range. So very steep rate cuts from the Federal Reserve as they tackle the economic weakness, prolonged economic weakness, according to the Fed's Beige Book, which said that they would expect to see a period of sub-trend economic growth between now and the end of 2024 and into 2025. So a long period of low growth and slow growth for the US economy. Moving on to the euro area and the next slide, that also sees a downturn in economic activity towards the end of this year and then negative growth in the first quarter of 2023 before a modest, and it will be a modest recovery in the second half of 2023. But this just leads to a stagnation in economic activity, again driven by weak household consumption, but predominantly it's investment spending that I think is doing quite a lot of the heavy lifting here. Again, there's the potential for weaker household consumption outcomes if interest rates have to rise higher than where we see the deposit rate rising to. So not much higher than where we will end this year, with interest rates expected to end this year at 2%. So another 50 basis points from the European Central Bank next week. Equally, there will be a further reduction in QE in terms of that there will be a quantitative tightening. So they're going to be directly selling some of the assets back into the market and allowing some of the assets that they bought to unwind. The question down at the bottom here is that the German economy now seems to be dead weight as far as the Euroland economy is concerned. So if that performs worse than expected, will that drag other economies with it? And I think the risk is that particularly in Northern Europe, that may well be the case. Moving on to the next slide and the UK's economic outlook. Now, I've already said that they're going to perform the worst here. And actually, you can see that the breakdown here, it's household consumption, it's investment spending, it's even a bit of a drag from net exports that's causing a lot of the pain in 2023, and a rise in the unemployment rate, which could be larger if we see more of the services sector businesses, particularly in hospitality and retail, struggling under the weight of high inflation and also higher interest rates. Again, we're looking at a peak in the bank base rate of around about 4.25%, which is materially lower than where the markets are forecasting. So our numbers might get worse if the Bank of England do raise rates more in line with what the market's forecasting, up towards 4.5%, 4.75%, versus where we think rates will peak at. Note also quantitative tightening here with regard to the QE stock coming down quite sharply as far as gilts are concerned. So quite a sizable sell-off in the QE stock between the end of this year and the end of 2024. Moving on to interest rates and what we're seeing here, there's not been a huge amount of movement. Marginally higher peak for US rates versus what we were looking at from the market implied forecast at the beginning of November. A marginally higher peak for UK rates as well, but also notably versus the November forecast or November implied numbers, rates we're seeing coming off An interesting, a little bit of fluctuation as far as the US is as far as Euroland is concerned, with the euro rate peak expected to be around 3.6%. So marginally above 5% peak for US interest rates. That's the upper bound for the Fed funds target rate. As far as bank rate is concerned in the UK, somewhere around 4.65% being the expectation from markets. And in Euroland, we are looking for rates to be around 3.6%. That's the refinancing and not the deposit rate, according to financial markets. So there is material differences between what we're expecting and what the markets are expecting. Worthwhile noting that UK rates may peak lower, as you can see from the forecast that I showed you in the previous slide. Euro rates and the US rate peak might be too low. It is all dependent on the stickiness of inflation. Recessions are happening in the UK already. They may be underway in the US at the beginning of 2023. And in Euroland, we're expecting at least a couple of quarters of negative economic activity. Now, if we move on to inflation, and this is where I think we get some potentially positive news, certainly from the US and Euroland, the headline inflation rates look as if they're dipping back. In the UK, we haven't seen that yet. In fact, the October inflation numbers rose to another 4-decade high in the 11% region. Driven by a lot of necessity goods inflation, food price inflation continuing to climb, energy price inflation may well tail off in the second half of 2023, but for the remainder of this year and into Q1, Q2 of 2023, I think we are going to see further increases in the energy price cap as measured by Ofgem. So just watch out for that. In the US, I think there are some threats as far as inflation concerns, some upside threats as far as inflation is concerned, because the core inflation rate does look stickier now, and so those drops in the headline inflation rates associated with more volatile elements like food, like energy, and like fuel, you might see a crossover in the headline inflation rate versus where the core inflation rate is. But the headline inflation rate numbers are encouraging. One other point to note, possibly not picked up in the latest payrolls number out of the US, was the rise in average earnings growth, which rose back above 5% in the November measurement. In the UK, average earnings growth is running at around 6%. So notable there in terms of some headwinds in terms of bringing the underlying inflation rates back down again. If I move on to my final slide before we go to Q&A, this is a more detailed look at what our FX market forecasts are. We've certainly seen quite a sizable move back as far as sterling dollar, euro dollar are concerned from the lows that we were seeing only a couple of months ago. I think this is a predominantly dollar-based move. I don't really see that much in the macroeconomic picture to support sterling over the course of the remainder of this year and into the early part of 2023. There are potentially some downside risks as we head into the end of the year associated with lower volatility and also just how much the move we've seen has been in terms of sterling dollar appreciation and euro dollar appreciation. Just think of it as a correction on a correction. The correction in terms of the big dollar buying that we saw against the major currencies. Then we've seen big dollar selling, potentially some position squaring in the market. Nothing really to do with the fundamental picture, although I think there is some potential for euro outperformance against the likes of the dollar and sterling into 2023 and beyond. The other thing to note is that materially we're seeing some big swings in the currencies around the likes of the Chinese renminbi, potentially some upside in dollar yen in the short term. So that might be the last hurrah of the US dollar in terms of its strength according to these year ahead forecasts. I do still see the risk being that if there is a material weakening in risk appetite, if there's a material weakening in the global economy, more so than is already priced for, then the markets might rush back towards the US dollar, being the economy that exudes the greatest potential stability as far as its financial markets are concerned. So there are some risks there as well. Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.